The main distinction between today's mode of conquest and that of 16th century Spain and 18th century France is that it is now largely financial, not military. Land, natural resources, public infrastructure, and industrial corporations are acquired by borrowing money. The cost of this conquest turns out to be as heavy as overt military warfare. Landlords pay out their net rent as interest to the banks that provide mortgage credit for them to acquire property. Corporate raiders likewise pay their cash flow as interest to the bondholders who finance their takeovers. Even tax revenue is increasingly earmarked to pay creditors, often foreign, as in medieval times, not to invest in infrastructure, pay pensions, or spend for economic recovery and social welfare. Today's monopolization of affluence by a rentier class avoiding taxes and public regulation by buying control of government is the same problem that confronted the classical economists. Their struggle to create a fairer economy produced the tools most appropriate to understand how today's economies are polarizing while becoming less productive. The physiocrats, Adam Smith, David Ricardo, and their successors refined the analysis of how rent-seeking siphons off income from the economy's flow of spending. The classical critique of economic rent, classical value theory, provides the clearest conceptual tools to analyze the dynamics that are polarizing and impoverishing today's economies. Rent theory became the basis for distinguishing between earned and unearned income. Nearly all public regulatory policy of the 20th century has followed the groundwork laid by this Enlightenment ideology and political reform from John Locke onward, defining value, price and rent as a guide to progressive tax philosophy, anti-monopoly price regulation, usury laws, and rent controls. But defenders of landlords fought back. Instead of acknowledging the reality of predatory rentier behavior, financial lobbyists depict lending as being productive, as if it normally provides borrowers with the means to make enough gain to pay. Yet little such lending has occurred in history, apart from investing in trade ventures. Most bank loans are not to create new means of production but are made against real estate, financial securities, or other assets already in place. The main source of gain for borrowers since the 1980s has not derived from earnings, but seen the real estate, stocks, or bonds they have bought on credit rise as a result of asset price inflation, that is, to get rich from the debt-leveraged bubble economy. What makes classical economics more insightful than today's mainstream orthodoxy is its focus on wealth ownership and the special privileges used to extract income without producing a corresponding value of product or service. Most inequality does not reflect differing levels of productivity, but distortions resulting from property rights and other special privileges.